Well, it seems China still has the upper hand when it comes to trade with Africa. Just last year, China got the biggest piece of the pie when trade between the two regions rose by 15% to $170 billion. Is mutual benefit a possibility? Let's find out from Managing Director for Emerging Markets in Africa at Deloitte, Martin Davies. Thanks so much for your time, Martin. Appreciate it. So China is pledging $60 billion for Africa over the next couple of years. Still, some are calling it a debt trap.
That's the new sort of rhetoric we're hearing, debt trap diplomacy, a lot of rhetoric out of our IMF, International Monetary Fund. Barack Obama's previous advisor wrote an article last week in the US media talking about exactly warning against the money coming from Beijing and strings attached. I think it's a bit harsh, to be honest. A lot of ultimately the fiscal governance, good fiscal governance of a state is dependent entirely on the government of that country. Yes, rising debt levels from the likes of Angola, Zambia, Ethiopia, Kenya, Zimbabwe, undoubtedly, amongst many others. And increasing that debt is being held by Beijing. Do you blame the provider of the capital or the fiscal irresponsible receiving states? I would tend to sort of talk more about the latter. So we've seen it's not an African phenomenon per se. It's also happened in Latin America. I think Venezuela. I think it talks to perhaps some erroneous lending practices by the Chinese in recent years. But that's a consequence of state capital. State capital is always directed and loaned on the basis of different risk metrics, if you will. It's state capital after all. Who's accountable? The state is geopolitical money. So yes, but again, having Beijing as a creditor nation, they tend to be somewhat less onerous. And of course, that debt the can will be kicked down the road ultimately anyway and renegotiated sometime in the future.
But let's talk about the power Beijing will have over African countries if they've lent us all this money and they need to come up and set up shop, let's just say in Kenya, for instance, or South Africa. They still have some advantage having lent that money.
Well, I think we're in a sort of a leverage, of course, equals influence. And we see that in traditional powers. Now we see it in emerging powers. Think China and Africa, perhaps a few others. I look at the case in South Africa in recent. We had the BRICS summit not too long ago, a month or so ago, and now it was followed up by the FOCAC, the Forum on China Cooperation, where President Ramaphosa was, and almost every other African head of state. But you know, we've seen the loans provided to the likes of Eskom, Transnet from the Chinese, and ultimately what I believe is so many very poorly managed, moribund, state-owned utilities across the continent require privatization. Maybe if his debts aren't serviced, that privatization will be forced by the Chinese creditors. And surely, I would argue, that's a long-term positive.
Well, that's a political interference or implication that our president just said today will not happen with China and South Africa.
Well, we shouldn't. Capital, no matter where it's from, behaves typically seeks returns. Of course, there may be a political angle to it. I think because it's new capital, new questions arise. And somehow I don't want this, it's almost sort of, I hate to use the word, but almost an emotional reaction to Chinese capital because it's Chinese per se. We don't see similar concerns of Japanese capital. Perhaps we did maybe in the late 80s. But my only concern is wherever the money comes from is largely irrelevant. But status capital, there is a strategic intent there ultimately.
Yeah. So is there mutual benefits here?
Undoubtedly. I mean, I disagree with the comments earlier saying that somehow the Chinese, taking all our resources. Well, what would we prefer? To leave them in the ground? We need to sell whatever we have. In South Africa's case, 50 to 60% of our export basket is commodities. In other countries' cases, it's typically up to 100%. Think Angola. In Nigeria's case, it's maybe 95%. So what else is there? China has been incredibly enabling the last 2 decades and incredibly enabling in terms of resource-propelled economies. So China's strong demand for resources has underpinned its own industrialization. That demand has been very inflationary for commodities. And considering that's our largest component of our export, that's obviously very positive. If commodity prices are low, that's a bad thing for Africa. Where would we be if there was no China? And extrapolating down maybe a few years' time or maybe longer, nobody knows, is that, heaven forbid, there's a crisis in China or a dramatic slowdown from the steady highs of 6–7% we're still seeing, imagine a China at 2 or 3 or 4. What impact would that have on commodity prices? That's very, very negative knock-on effect for African economies. So the question I'm posing is in the event of a China crisis, the dramatic negative effects for Africa will then truly be felt.
Yeah.
So we should be hoping that China's demand for our commodities and taking whatever they can out the ground, continue fueling and supporting Chinese growth, the resource-intensive growth model, continues unabated.
And I see that President Ramaphosa made it quite clear as well in his meetings in China that we're not going to just export raw materials because you sell things back to us at a higher price. We want to now start selling products and exporting those products to China. Do you think they'll accept that?
Well, this is just political rhetoric. It's meaningless to me. States, countries don't trade. Companies trade. States don't make things. States don't export things. Companies do. So all states do is provide enabling platforms for companies to exist and trade from or to. So it's up to the government, maybe newsflash, not to think about how do we produce different stuff or more value-add stuff and affect trade balance. And I think Donald Trump hasn't quite learned this yet. But how do states create enabling environments which companies can thrive, produce better stuff, and ultimately export based on trade arrangements that are negotiated by the state in a very pragmatic fashion with trading partners.
Yeah.
So it's not about, well, we don't produce that and China produces this. That's not the point. It's about companies, not about countries.
And of course, some are arguing that China is now desperate to, cement ties with Africa because of the import tariffs imposed by the U.S. and the trade war between China and the U.S.
Yeah, it's incredible, this geo-economic shift that has taken place, and Africa being part of it. Since Donald Trump came in, the US is doing everything wrong in terms of courting the continent, and China's doing everything right. We've had 2 back-to-back summits, the FOCAC summits. I was the first one in 2000, that's 18 years ago, and attended almost every one. And to have a consistency over the last 18 years, every 3 years, triennial summits, of seeing the policy pronouncements by the Chinese, the committal of significant amounts of capital. It's been a very consistent partner for 2 decades for Africa. It's been enabling, as I mentioned, on the commodity demand side. There's the demand side of commodities, there's supply side of capital. And the last few days, again, $60 billion. I mean, it's a lot of money, but spread across 1.2, 1.3 odd billion people in 54 countries is not that much. So it's more about the real issue is how do African countries compete for this capital? Because it ain't going to be equally distributed.
Yeah.
And I want to see South Africa, rightfully so, getting our fair share, but not based on a political relationship, but based on a well-growing economy in SA, creating opportunities and creating very attractive assets that Chinese capital can invest into.
Thanks so much for your time and your insight. Appreciate it.
Thank you.
That was Managing Director for Emerging Markets and Africa at Deloitte, Martin Davies.